put both of these, the previous day and today's, under Chapter 2. Okay, so we're going to wrap up Chapter 2 today, and hopefully even get through some of the quiz questions and be able to hit the ground running, hopefully, with Chapter 3 on Wednesday. Okay, so class has started here, guys. So let's go ahead and let's just remember a couple things that we said from Wednesday. And we started out talking about various types of cost, and we had our manufacturing cost. And manufacturing costs, we said, were what? Were our direct materials, DM. We had what? Direct labor, and we had, well, we had manufacturing overhead in general, right? Okay. Now, obviously, our direct materials and our direct labor, we said, are both what? Direct cost. Couldn't resist, looked like a bug. So, okay, our direct cost, and then what? We said that our manufacturing overhead was indirect. Okay, and with indirect, we had indirect labor. We had indirect material. I guess that's, what is that, a class where they teach you how to clap over there? Indirect materials, indirect labor, and then we had the others, which were things like what? Like depreciation and the utilities and some of those things, right? Right. Then we also, we said that these are all manufacturing costs. We also said that these are product cost, right? So remember, I said one of the major challenges is just remembering all the different names for what ends up being the same thing in many cases. Okay. Now, we said that with our manufacturing costs, that our manufacturing costs would be gathered and reported on the balance sheet. I do that because I'll keep picking up the same non-writing pen, and that drives me nuts, so I want to get rid of that one. But we said we would gather those costs on what? The balance sheet in the form of inventory. And then as we what? As we sold those items, they would hit the income statement as the cost of goods sold, right? Okay, I think that was most of what we said about our product cost, our manufacturing cost. Oh, and then kind of a big deal in that what? Direct costs go directly to the product. Our what? Our indirect costs we would have to apply. We would have to apply those to our product costs, right? Okay, we'd have to have a process of applying those. Now, we also talked about what? Non-manufacturing cost. Should I go over there and tell them to stop clapping? Okay. One time I was teaching doing a presentation here it so happened to be at San Jose State, and it's before I was teaching here, and I'm giving the presentation, and all of a sudden the lady comes from next door and says, "Can you turn down your microphone? My students are taking a test." And I'm like, "Well, I'm not using a microphone, but okay." All right, I get it. Okay. So then we have our non-manufacturing cost. Our non-manufacturing costs we also called what? Period costs. And it was our selling and admin cost, right? Now, the selling and admin costs can be also what? direct or indirect. Okay, they can also be direct or indirect. For example, our CEO's salary is probably indirect. Our advertising is probably indirect. But if we have what? If we have, say, sales commissions, well, that can be direct because you pay a percentage of whatever the sales price is to your salesperson, right? So sales commissions can be direct as well. Okay. Now what happens here is we go ahead with our selling and administrative costs, and they do not stop at the balance sheet. They go straight to the income statement as what? Expense, thus the term period cost. They are expensed as incurred, right? Because of the difficulty of trying to, apply our advertising, say, to particular, um, any one particular product or whatever. So these costs are expensed as period cost, right? I think that was pretty much what we talked about last time. Anything else? Oh yeah, the Who Cares channel, right? So we said that what? But that's a good point. We said that what? That our product costs could be grouped into two groups. We could take our direct materials and our direct labor, call it a prime cost. We could take our what? Our direct labor and our manufacturing overhead and call them conversion costs, right? Okay. All right. So what we're going to do now, and I'm going to put the screen down here in a second, but before I do, I just gave them to you. What do you mean? Is there an example? Sales commission is direct because I pay a percentage, say 5% of the sales price to a salesperson, right? You ever had a salesperson that won't let you go when you get into a store? That's because they're getting a commission probably, right? And so they know that if they sell you, a chair for $1,000, they're going to receive 5% of that in their paycheck. So what are they going to get? $50 in their paycheck for selling that chair? Well, that's a direct cost associated with that because when they sell the chair, they get the sale, don't they? So it's direct. Another direct selling and administrative cost. If we took out an ad in the newspaper or took out a specific advertising for a specific thing. I reckon. It's usually not when we talk about it in the class, but huh? A coupon most likely would be indirect. With coupons, we're under FASB rules. We have to estimate what we think the redemption rate is going to be associated with those. And we usually use some sort of straight line method to take that. So if we think the redemption rate, because not everybody uses coupons, so we have sales, and we would go ahead and set up a contra to our sales for the amount that we think is going to be redeemed, and we would take that as like a reduction off of our sales based on whatever we think the redemption rate is. So we don't wait until the coupon comes in to treat it as a cost. Or wait till those coupons are used to treat it as a cost against. We usually have a redemption rate associated with that, but we're getting into intermediate accounting now. Okay. Yeah. Warranty is indirect, but you're going to take it at the time of sale. You would take a warranty expense at the time of sale, and you would treat it as a period cost. And you set up a liability for whatever you think the warranties are going to be. And then it works like the allowance. As they're redeemed, you go ahead and debit the contra, the liability that you set up, not contra asset, but the liability that you sent up, and credit whatever the cash is or salaries payable if you have in-house working on those warranties, whatever it is. But again, we're up in intermediate accounting at this point. But yeah, I think warranties would be an indirect, and it would be treated as a period cost because you base it on sales. So if I have $100,000 of sales, and I think that I'm going to have a warranty expense of say 2%, at that time I would take, what's this, 2,000? I would go ahead and debit warranty expense and credit estimated liability for warranties for $1,000 or 2,000 in this example. And then as people actually come in and want their stuff fixed, I would debit the warranty expense for say 500 and credit, and I don't know, I may have to credit materials for 200 and labor salaries payable because I have to pay the people to work on that for 250 whatever, or 300. And that's at the time that they actually come in. But the warranty expense in and of itself is a period cost because it's matched with the sale, right? And I'm kind of saying the same thing about coupons. Coupons, you set up a liability for those at the time of sale, and you go ahead and you and instead of treating it as a dispense, we treat it as a contra against the sale so that the sales are reduced net of what we think coupon redemptions on those sales would be. Or if we just have coupons in general out there, again, we come up with a redemption rate on those, and that's going to be a contra, to our sales in the period that and if we think it'll be over 3 years, then we should take a third of that a year, whatever, however long we think it'll take for them to deal with those. Anyway, we're well into intermediate though, but these are considered intermediate. These are considered indirect costs. This is intermediate accounting 2. It's not even intermediate 1. Okay, so anyway, we have these different examples. I don't know if I got 50 examples here of direct selling and administrative, but sales commission would be direct. Okay, so we come over. I'm a little confused. Why do you want another example, just out of curiosity? If I've given you one, why do you want me to give you another one?
Well, I was just trying to get a better understanding of what would be direct and indirect. I mean, it seems a little hazy at this point.
Why would you not understand that would be direct? So now I'm glad I asked that question.
What would not be direct?
Why would you not understand that that's direct? If I have the sale and I have to pay a sale, so why would you ask for another example?
Well, I'm trying to think of more.
Why?
Just so I know for future reference.
Do you understand the concept?
I understand the concept.
Then you'll know it when you see it. Okay, I can't sit here and give you 50 examples of something, but when you know the concept, you'll know it when you see it, right? Well, why wouldn't you know it when you see it if you know the concept?
I just wanted to be sure that I would be prepared to identify for some indirect. I get it
Right.
from running, just not prepared. I think I'll get it eventually.
Well, why do you say you don't get it? Do you not understand the concept that if we have a sale, we also take the commission at that point in time, and that makes it direct?
Sales commission example, but I wanted to know for something else and be sure that what I think is direct.
But if you understand the concept, you'll know it when you see it, right?
Yes.
Okay. Okay. So now we have these, this is pretty much what we said last time. And then we have what? Then we have variable costs, fixed costs, and mixed costs. And what we're going to do with these costs that we have up here is try to see how they fit into these categories of costs. Okay, now a variable cost will do what? It'll increase or decrease accordingly with the level of production. So if I have more production, what? My variable cost will go up. Less production, my variable cost will go down, right? So how about my direct materials? That's going to be what? Variable. If I produce more sandwiches, I have more material costs. If I produce more cars, I have more material costs, right? Okay. How about what? Direct labor. The more what? The more items I produce, the more labor I have to incur, right? Okay. Okay, good. How about fixed cost? Do you think we have any up here? Get rid of this warranty entry. Huh? I don't know about utilities, but how about depreciation slash, I'll put rent here too. Depreciation slash rent. What happens? Let's say I make a whole bunch of people sick with my sandwiches and nobody comes to my sandwich shop anymore and I've rented the place for 12 months. The guy's still going to expect me to pay the rent even though my sandwich shop is going under. He's going to say, well, gee, that's too bad. Where's my $5,000 rent or whatever it is, right? Okay, so rent depreciation will typically be what? Fixed costs. They're not going to change with the level of production. Now I say that assuming with depreciation, I'm assuming straight line depreciation. There is a depreciation method called units of production that takes depreciation based on what? On how much you use that particular machine or whatever it is. And so if I'm producing more, I'm theoretically using that machine more. So we could take depreciation and stick it in what? Variable if we were using that manner of depreciation. But for this class, we'll assume straight line. We'll assume that depreciation is fixed, right? Okay. Okay, good. Now mixed costs are such that they have both a fixed component and a variable component. So if this is costs on the y-axis here, then I guess it could be the cost axis, whatever. And this is what? Units on the x-axis, however you say that. Then what happens? My chart's a little weird, but what happens? Our costs will be fixed if we produce no units, and as soon as we start producing units, we'll start incurring some of these costs. So some costs are what? Mixed in that they have a fixed component, but as we start using them, we also, using whatever that cost is, we start using up some units, we'll also have what? A variable component, okay? So can you think of an example of a mixed cost? Mixed now? Get rid of this chart. Good. The utilities, the electricity can often be what? Can often be mixed in that if you sit there and you turn out all the lights in the sandwich shop and sit there in the dark like this, you barely breathe, you will still have a PG&E bill at the end of the month because they're going to charge you what? I don't know, whatever it is. I don't know. I never got a bill where I didn't use anything, but $40 just to have the wires, just to have the notion of lights that if you flip the switch they'll come on, right? They'll charge you a flat fee for that, right? Okay? So good. Utilities can tend to be mixed. Okay? Now what happens? Remember, we said that we have to apply our overhead to our product, don't we? Okay? And so we're going to look at this entire overhead component, both the direct, indirect, and the others. We're going to look at this entire overhead component as a mixed cost. when you look at it as just one big set of costs, the what? The manufacturing overhead, there's some variable in there, isn't there? The indirect material, the indirect labors. Is there some variable in there? Okay, there's also what? There's also some fixed in there, right? The depreciation, the rent. There's also some true mixed in there. So if you look at that whole category, it's a mix between what? Some fixed costs, some variable costs, and some mixed costs. Well, if that's the case, if we're sitting there and looking at the manufacturing overhead as really being a variable, a mixed category, I should say, then we should be able to do what? We should be able to predict how these costs work using something like we just drew up here a minute ago, where the what? The y-axis is the total overhead cost. I'll just call it total, call it TOC, total overhead cost. And what? And the units are whatever we've determined the driver of our overhead cost to be. Now we can predict the way these costs are going to act, and that our total overhead cost is going to have what? A fixed component and a variable component, isn't it? Okay. And our driver, I put in parentheses, often is going to be direct labor hours. We will often say the main thing that drives our overhead cost is our direct labor hours. Doesn't have to be, but it could be. It just depends. Okay. Some entities, it could be my electric utility hours. Okay. I was on an assignment one time with my office, the GAO, Government Accountability Office, Auditing Arm of Congress. I worked there 26 years, I mentioned the first day. And we were on an assignment one time where there was a plant that exploded. This plant produced the oxidizer for solid rocket fuel. Okay, oxidizer is what makes the fuel burn. And there was one plant that so happened to be very sloppy with how they kept that oxidizer. They let it spill and they wouldn't clean it up and stuff. And guess what happened one day? The whole plant blew up for like half hour. The thing just kept exploding. And by the time the explosions were done, there was nothing but a hole in the ground. So Congress asks us, so what happens? It turns out that there was only one of two plants in the entire country that made the oxidizer that makes rocket fuel burn. And Congress isn't too happy if you're down to one plant that's fueling all your missile systems and everything. So they asked us to go look to see if the second plant was going to blow up. So we go, and it turns out that it's just outside of Las Vegas in Nevada, and we find out that there's a huge amount of electricity that is needed to make this ammonium perchlorate, which is this junk that makes the rocket, makes that oxidizer that makes the rocket fuel burn or whatever, and you need all this electricity to produce this stuff. So why are they outside of Las Vegas? In case they need more electricity, they can go gamble. Hey, put some money down on red, man. We need some more money for this. Okay? They're outside of Las Vegas for the same reason Las Vegas is lit up 24/7. Hoover Dam is right there. And so you get what? You get low-cost electricity. That's why Vegas stays on all night and all day with all those lights. They're getting low-cost electricity. That's why that plant was there. Okay? So if you were trying to do what? Allocate overhead in a facility like that, then the driver would be whatever the kilowatt hours you use of electricity, right? So it's not just one driver, always direct labor hour. We use it a lot in this class, but it's really is what is a major driver, a major cause of your overhead cost is what you use as the driver, okay? But we'll often use direct labor hour, okay? But when you look at this, you can sit here and you can see that what? You can see that we have set this up for this sort of a cost function. And as you've known for a long time, that when you look at a mathematical function like this, you can write that out as the equation y equals mx plus b. Isn't that an equation for that cost function that is what? Fixed at 0, but then as soon as you start producing, it starts to increase by the number of units? Okay? Okay, good. Well, if that's the case, we're not stuck with those stupid mathematical terms. We could say total what? Total overhead cost then must be equal to the what? The variable cost per unit plus our fixed cost. Isn't that the same thing? Isn't that the same thing? Okay. And what we're going to see is there are tools that will allow us to come up with a prediction as to how something that moves like this is going to produce our cost estimates. Okay. Now, there are various methods. There's regression analysis. There's something that we're going to study in here called the high-low method. High-low method turns out to be the easy one, and I'm going to teach it to you because I'm not interested in decision science, blah, blah, whatever class that is. Let them teach you regression analysis in there. I just simply want you to understand that we're going to use a method to do what? To predict what our overhead costs are going to be using this sort of a relationship. Okay? Now, I'll just show you, though. With regression analysis, they're going to sit here and they're going to plot all of these different points of our total cost, wherever they lie. They will simply plot them, and then they will go ahead and pretend, using statistics, pretend that there's a line right there that fits in the middle of those. So before I draw the line in, I guess it would make more sense to you visually anyway. They plot all the different points. What is our total cost at these different levels of production? And then they just pretend. They use statistics to pretend that there's a line that goes through the middle of that. And that is a way of estimating what we think our total cost will be at different levels of production. Okay? Now that is a more sophisticated method, going to give you a better answer than the answer that we come up with using the high-low method. The high-low method does this. It looks at all these points, wherever they are, and then the high-low method says we're going to take the low cost and we're going to draw a line to the high cost, and that's how everything lines up along that line. And we assume that everything lines up along that line when you can see the reality is what? There's cost all up and down that line. Much more what? Much more of a rudimentary method of doing this. I don't expect that this would be used much in practice. All I want you to come away with is the idea that what? We need a way of estimating what our overhead costs are going to be so that we can come up with a predetermined overhead rate that we will then apply to each job as we incur whatever the driver is, kilowatt hours, direct labor, whatever it happens to be. Okay? Okay, so that's where we're going with the next several slides. Is there a question at this point, though, before we continue on? Okay? Okay, good. So let's go ahead. Wow, that's quiet. Okay, and let's put ourselves into slideshow from current slide. Okay, and take this guy out of presenter view. And let's see if we can get this thing down without messing it up. Okay. All right, good. So we have these different costs, and we've seen how they move. And let's just see how this would work to make sure we're clear on something that, difference between variable and fixed. Okay, let's start with that. and we take a look. I'm not going to do it for an exercise. Let's just take a look at the answer here, okay? So we have what? We have our cost item here, executive salary. Executive salary is usually fixed, okay? They pay him $2 million a year, no matter how much he screws up or how good he does. He gets $2 million a year, and we expense it. It's an administrative cost, right? What's better, this, or this? Okay. Okay. I feel like we're at the eye doctor. Do you like that? How's this? Okay. All right. So then what? Then we come over and we have what? We have the direct labor. Direct labor is variable. It is a product cost. Direct materials, variable product cost, right? Depreciation of factory equipment, it is fixed. It is a product cost as part of my overhead, right? Unless we're using the units of production method, which we're not. But if you're assuming straight line, it is. How about indirect labor? That's what? Product, and it's going to be variable. Okay, delivery expense, there we go. There's another selling expense that is what? That is fixed, and that it's, that is variable. We didn't say it was fixed again. It's another, thank you. It's another direct, what? Selling expense that you pay the delivery cost at the time that you have the delivery. So it's direct, even though they weren't asking that on this slide, and it is what? It is variable. You don't incur the expense unless you have delivered the item, right? And it's a selling cost, so it is a period cost. Okay, television advertising is going to be what? Going to be fixed. It is a period cost. Typically, it would be indirect. It could be direct if you were advertising for that one thing, I guess, right? Then it could be direct. But usually advertising that's the whole point. It's supposed to cover a lot of different things, right? Okay. And then indirect materials are going to be variable, and they are product. Okay? Mm-hmm.
Why is delivery expense a period cost? If it's variable, doesn't that mean that it's going straight into the specific profit they delivered?
Because product costs are costs that are going to first hit the balance sheet and then hit the income statement, right? Direct material, direct labor, and our manufacturing overhead, and they sit there on the balance sheet until we sell the thing, right? Okay, delivery expense is not, freight out, never sits on the balance sheet. It goes straight to the income statement, doesn't it? Therefore, it is a period cost, and it is direct because you don't incur the delivery cost until you deliver the thing that you're selling, right? Okay? Okay, good. And half of this challenge here is getting these terms right, right? As to what it is we're talking about. Product costs, period costs, manufacturing costs, non-manufacturing costs. Well, that's the same thing. Some can be direct, some can be indirect. You know what they call that? They call that a random pattern. Think about that phrase for a second. Random pattern. Okay? All right, so you come over and you take a look at this, and they're using it, guys, just in the context of a mixed cost in general, but I'm telling you, as I just wrote on the board, we can what? We can set up a function for our overhead costs like this as well, can't we? Where it's fixed for a while when you have nothing, and then as you start to produce, those variable costs are incurred, and your variable costs are going to be what? They're going to be pushed up by your what? By your fixed cost, right? Okay. Okay, good. Now, they've used a different, they didn't want to use y equals mx plus b, and so they use y equals a plus bx now, where y is the total cost, what a is the fixed cost, b is the variable cost per number of units of the driver, and x is the units of the driver. Okay, now you say, well, why did they use a, b, whatever? This is the way it is commonly written if you're using regression analysis, And so they figured, okay, since regression analysis is sort of the state-of-art way of doing this kind of work, now we'll use the regression cost symbols. I like to just draw it for what we're doing here, which is what? Total, and I left out the O, but total overhead costs equal what? Equal fixed costs plus our variable costs per unit times the number of units that we use up in our driver, kilowatt hours, direct labor hours, machine hours, I don't care. Whatever it is that drives your cost, and that's going to be relevant to whatever type of business you happen to be in, right? Okay, so we go ahead, and in this example, they say that our monthly fixed, and again, we could replace the word utility charge with overhead, is $40. Okay, maybe that's your rent, or that'd be a nice rent, your utility bill, whatever, the fixed part of it anyway. Your variable cost is 3 cents per direct labor hour, electricity kilowatt hour, whatever it is, and your monthly activity level is 2,000. That means that you are going to what? You're going to say that your total overhead is 100. Now you look at this and you say, well, John, what good does this do me? I would clearly already know what my utility bill was. I mean, I see what it is. Why do I have to come up with an equation to predict it? Well, the reason being is that you are more likely going to use your historical data, which is what we learned all about in Business 20 in your intermediate. You use that, historical data, and you pull it into this model to predict what's going to happen next year. And then next year, as you sit there and you incur these direct labor hours, utility kilowatt hours, whatever it is, you will apply those overhead costs to each job as you incur those costs. Don't we have to figure out a way to apply them? So we've just come up with a relationship between, say, direct labor hours and our overhead pool, so that every time we have some direct labor hours, we apply some of those overhead costs to each job that way. Have we achieved the objective of applying costs to our overhead? Okay, because remember, that's the whole point. It's indirect. We have to apply it to get it over there to the product cost, the manufacturing overhead. Okay? All right, so let's just look at this example here, and we've got this high-low method. And again, guys, I'm telling you, this is the baby class method, and I'm not treating you like babies. It's just that I don't want to spend time dealing with regression analysis in here. That's decision science. I'm going to let them teach that to you. I'm sure they will. I just want you to know that we're going to get this number, and we're going to use this number to apply it to our jobs as accountants. And the more sophisticated the operation is, the more sophisticated should be the model to come up with what our predetermined overhead rate is, and the more we should be relying on the engineering department or somebody like that to just give us that number. As accountants, we don't sit there and say, well, let me get in there and estimate what the overhead rate is going to be if we have a highly sophisticated operation. We'd probably turn to our engineering department, whatever, and say, we need this number. This is what we're trying to do. Get it for us, right? Okay, but let's just go ahead and let's just take a look at this very basic method, and notice they have the and just pretend this is the total overhead cost and the number of direct labor hours, and they track those month by month here. So in this side of the accounting house, whatever, the accounting department, I have my people that keep track of direct labor hours. That's all you do. You get the time cards, you see what the direct labor hours are, right? On this side of the accounting house, I have people who do what? Who track the amount of our total overhead costs each period, month to month. So I've got these two numbers, don't I? Okay, and I go ahead and I put them on this spreadsheet. Now in this example, they stopped at June because they didn't want, 8 years worth of information up here. In fact, they didn't even want to deal with 12 months to make it a short example. So, okay, the more data points we have to observe, the more accurate our estimate's going to be, isn't it? Okay, but we've only got these 6. That's okay. We look at this chart and we pick the high month and we pick the low month. And so we see that Month of June had the high cost, the high number of hours, high overhead cost, high number of direct labor hours. And what? Looks like February was our slow month. Low month, our low number of hours, our low number of cost. Okay? Now what we want to do is pick up the slope for this line. And you remember that when you have y equals mx plus b, the way you get the slope is by doing what? Picking 2 points that you're going to say are on this line, y2 and y1. Okay, that's the 2 points, y2, y2, y1. You have those 2 points that you're picking, that you're saying all your points are falling on that line, even though they're not. Notice I have these other little lines, little dots around the line, but I just pick 2 dots, connect them up, and I say all the points fall on that line is what I'm going to assume. And so I go ahead and I have y2, y1, and I divide that by what? The x2 and the x1. Okay, I pick my 2 points on the x-axis, and I divide y2 minus y1 by x2 over x1. The change in y divided by the change of x gives me the slope of this line, right? That's telling me what? For each point I move along this line, how much does my variable cost go up at an even pace, right? And so when we look at the high-low method, okay, all I'm doing is I'm taking what? Total cost 2 minus total cost 1. The what? 9,800, the 7,400. That gives me a difference of 2,400, which is that number right there. And then they're saying what? Hours at 2 minus hours at 1. I'm calling that x2, x1. I guess I could have said h2, h1. But that difference is what? 400? And they do the math, and our variable overhead cost is $6 per hour. Isn't that beautiful? Is it really? It's some other funky number because what? All the points, if all the points lined up right on this line, then we'd be the luckiest people in the world. We would have a perfect relationship between our variable cost and the number of units. Unfortunately, nothing actually works that way. But we're going to go ahead and assume that it does, right? Okay. Now, if it doesn't line up perfectly along that line, what the mathematics, what the observation points are telling you is some of your costs that you think are variable, they got a little fixed in them. What are we going to do? Okay, they're not going to necessarily be perfectly variable, but we're just trying to come up with our best estimate here, aren't we? Okay, so we go ahead and we see that our variable overhead cost per unit is $6. Now, once we can figure out what our variable overhead costs are per hour, then we can come over and we can figure out what our fixed costs are, and you could either pick the high or the low. Are you someone that likes to be high, or do you like to be low? You like to be high? Good. Because that's what they used here was the high. They picked the high total cost, didn't they? They picked the high total cost, and then they took the what? Variable cost per hour, multiplied that by what the high number of hours were at that high cost. So they really are taking the total fixed cost and subtracting off what? Total fixed cost. Total overhead cost and subtracting off what? The variable cost, and that is going to give them the fixed cost, isn't it? Total cost at that level of activity, the what? Variable cost per unit times that level of activity is the variable cost. Difference is, presto, fixed cost, right? So now that I know what my fixed costs are, I can go ahead and set this equation up by saying what? By saying that my total cost will be equal to what? The 4,700 fixed cost plus, down here at the bottom, $6 per unit times whatever my driver is. Again, in a classroom environment, we tend to like to talk about direct labor hours all the time. Doesn't have to be, though, right? It could be machine hours, could be electricity hours, whatever, right? Okay. Okay, good. So let's say we are doing this, and we're doing this in June of 2017. Now we're doing this in June of 2017 because we want to determine what our overhead rate is going to be in, say, 2018. So we go ahead and we assume that we are going to have 1,000 direct labor hours in 2018. Do we know for sure? We don't know for sure. It's okay, because if our estimate's wrong, what's beautiful about accounting, if your estimate is wrong, you can just fix that. Now, we're building a bridge. We better be a little bit more sophisticated with how we estimate the way things are going to act, right? We can't sit there and say, okay, yeah, we think the bridge can take this much movement and this much during traffic patterns, and then, we get the cars out there and the things start. Sorry, let's try again. Those people, they were going to die eventually anyway, right? And we go ahead and try it again. That won't work, right? So, but for this, for accounting purposes, if it's not perfect, we'll just make an adjustment at the end of the year. Debit this, credit that, we're done. It's no big. Nobody dies if we don't get it right.
So in accounting, are they always going to use high-low method?
No, I would say most of the time you wouldn't, okay? And that you don't want a situation where your numbers are so off that you're having this huge adjustment at year end. So no, I'm teaching high-low method because it's easy. And what I'm more interested in is at this stage of the game is, do you know what to do with the debits and credits once you get the numbers that we're going to be talking about? That's what I'm interested in. As I said, if you have a more sophisticated operation, maybe you're using regression analysis, and if it's some really weird business you get into, well, we're talking about super colliders now. Well, it's not up to us to come up with the cost estimates. Then you're asking them, we need you to go in, you need you to tell us the fixed cost. We're going to need a variable cost per hour, and we're going to expect you engineers to go in and give us what that is. Okay, we don't just toss it to them. We would work with them, right? But we're going to need some help. Okay? Okay, so we go ahead and we assume that there's 1,000 hours that we're going to work next year, right? So we take what? We use our last year's estimate to predict our cost for the next year. We think our fixed costs are $4,700. Our variable costs are $6 per unit. The 1,000 times the $6 per unit plus the 4,700 means that we're predicting that next year we'll have a total overhead cost of 10,700. We are predicting that we're going to use what? 1,000 direct labor hours. So we are sitting here and we're saying that our overhead rate is going to be $10.70 per direct labor hour. Do we have a rate? Do we have a rate? But you're not getting 1070? Well, do you understand that our fixed costs are 4,700? You see where we got that? Do you understand that there's $6 per direct labor hour in this example? So I'm thinking that 6 times 1,000 is what? 6,000 plus 4,700 is 10,700. And when you divide that by 1,000, do you get 1070? Okay, so it's 1070 per direct labor hour, right? Where is the confusion, guys? I'm seeing some looks there, and I'm seeing some doubts. What's the problem? Do you understand where we got the 4,700? Everybody. Do you understand where we got the $6? Do you understand that the 1,000 is an estimate of how many direct labor hours we're going to use next year? We're doing this in 2017 using 2017 data, and we're trying to come up with an estimate for what, 2018? So do you understand that if we take our 10,700, what our costs were last year, and we divide that by the number of units that we think we're going to use this upcoming year, or whatever, that's going to give us a predicted overhead cost of $10.70 per hour. Right? Okay, so now if we're sitting there and we are trying to figure out the cost of a product, and let me just redo this example over here. I wrote this here the other day. Let's say our direct materials equal $12. Let's say our direct labor is $10 an hour, and we spend 5 hours on this. Do you understand that our direct labor would be $50? Our direct labor would be $50, right? Can anyone tell me then what our overhead would be? Because we have to have overhead too, don't we? For our product costs? What would our overhead be? Huh? Say what? 5350. Well, we have what? 1070 per direct labor hour. How many direct labor hours went into this product? 5 times 5. Is that where you got 5350 from? So our overhead is 5350, you say? Right? So if I ask you the total product cost here, what's that? 103.50 plus 12 is 115.50 is our total product cost here. 115.50 is our total product cost. The direct labor, which was direct, the direct materials, which we took direct, and the manufacturing overhead, which we have applied using this predetermined overhead rate that we set up back in 2017, didn't we? Estimated based on 2017 data. Now you're sitting there and saying, but John, what if our overhead costs in 2018 are not 10,700? Aren't we going to over or under apply our overhead? Yes, we are, and we're going to make an adjustment for that at the end of the year. Don't worry about it. We'll fix it. Okay, so what do? We sit there and we treat our overhead as though they are a mixed cost, don't we? We treat our overhead as though they're a mixed cost because there's some fixed overhead costs, there's some variable overhead costs, and there's some that are actually mixed, aren't they? So they behave like this. So since they behave like this, we can fit an equation to that following the theory of y equals mx plus b, right? Doesn't that predict the way that whatever this chart is showing is going to behave? Okay, so we go ahead and we say, okay, so total cost then equal what? Fixed cost plus the variable cost times the number of units in the driver in this class, often direct labor hours, but it could be machine hours, whatever it is, right? So we're predicting that this is how our overhead costs are going to behave. So we turn around and we say, okay, if that's the case, then let's come up with a set of observations for our total overhead cost and the number of units of the driver that we incurred month to month whenever we observe these total costs for our overhead, how many direct labor hours, whatever, did we incur, right? And when we do that, we can use a variety of methods. We can use regression analysis, whatever, maybe a little more sophisticated. For this class, we're going to use high-low. And we're going to pick 2 points, the highest and the lowest points, as we've graphed how our costs move with our direct labor hours. And we're just going to draw a line between the high and the low and assume that every point lines up on that line, even though they really don't, right? But that's okay. It's an estimate. We'll fix it at the end, right? Okay? And when we do that, we're able to do what? We're able to then say, okay, Well, then our total cost 2 at the high, which in this case was this 9,800, minus my total cost at the low, which was a 7,400, gives me a change in the y-axis and my total cost of 2,400. And then I'm treating my units as my x-axis and the high and the low there. 850 high, 450 low, that's a difference of 400. Change in y divided by the change of x gives me the slope of this line. Slope of this line is what? How much we move up every time we move across, right? And we assume that it moves at a uniform rate, even though it doesn't really. But we fit that line to it. We assume that it moves up at a uniform rate of $6 per direct labor hour, whatever it is, right? Whatever our driver is. And so once we know that, that's easy. We could do it at the high, we could do it at the low. We have to pick either the high or the low. You guys said you wanted to be high, so we picked the high. And so we went ahead and picked what? The 9,800 total cost minus the what? Whatever the variable cost would be at that level of activity, which is our variable cost of $6 per hour, times the number of hours at that high level of activity. Total cost minus what? Variable cost will give me the fixed cost. Now that I know the fixed cost, the b in that equation, whatever, of y equals mx plus b, but here we just stuck it in as what? 4,700 plus what? $6 times whatever the direct labor hours are, right? Now we know how we're predicting that our costs are going to move next year. And then we have to go to our production department and say, hey, how many direct labor hours do you think you're going to use next year, right? And they tell them, well, we're planning to produce, and we'll get into budgeting much later in here, but they'll look at the number of products they think they're going to produce and how long it takes to produce each product, and they'll come up with a direct labor budget, and they'll just pull out for us what? The hours. They give us the hours. We go ahead and divide those hours by what we think our total overhead costs will be at that level. It was the 4,700 fixed plus the $6 per hour of our variable cost. We add that together. That's our total overhead cost divided by the number of hours we think we're going to use. That's 1070 per hour, right? And then we put that number over the side and we wait until we start to produce products in 2018. And we produce a product, and in this example, we spent what? 5 hours on it. So we took this, what? We took this 1070 times the 5 hours. And what was your name, sir? Mateen? And Mateen and Edmund sat there and said, well, that's 5370, right? When you did the multiplication? 5350? Where'd it go? Right here. Did I write it, though? That it's 1070 times 5, right? Gave us 5350, right? So we took that 5350, that's our overhead. Our direct material, direct labor, we didn't have to go through all that because it's direct. We just trace it. But I can tell you what the product cost is for that particular item, right? Okay. Now, our only trick at this point is to get those costs into our accounting system, right? Because right now I'm showing you a bunch of numbers whizzing around, and I haven't shown you one debit or credit. Does anything get into our financial statements without a debit or a credit? No. Okay, they say the footnotes are an integral part, so I guess the footnotes don't require journal entries, but everything else requires a journal entry, doesn't it? So when we get into Chapter 3, I'm going to start showing you, now that we have that number, we're going to have to know how to make the journal entries to get it through our accounting system. So it'll hit our balance sheet first, and then as we sell it, it'll go to our cost of goods sold, right? Okay? Okay, good. Question? Okay, let's look at this one. I know it's a little hard to see here. They give us all this information, and they tell us they're using regression analysis. But then the question says, using the high-low method. Well, if they're using regression analysis, then they must not be using the high-low method, right? Okay, but we're just going to go and we're going to use high-low. So you look at the what? The hours of activity. You look at the cost. You look at your x-axis, your y-axis observation points, and this company had it for a whole 12 months. So we look, and the high hour of activity is what? This 520. And so we pick up the high cost at that, which is 4470, and we stick that into our what? Total cost 2 minus total cost 1 are going to be what? Divided by x2 minus x1. If you have good vision, appreciate it while you have it, because when it's gone, life will be different. x2 minus x1. Okay, total cost 2 minus total cost 1 over total units, high units versus low. I guess I could put, xh and x low if I wanted here, right? Okay, whatever. Okay, and so I've got my 4470, my 520, and then I'm going to find the low. And the low month is this 300 month, isn't it? So I take the 300 and I put that in the denominator, the 2820, that's my total cost 1, and I get the difference. Difference is the change in total cost divided by the change in the number of maintenance hours here. That gives me a what? A variable cost per unit of 750. That's the slope, isn't it? Now this problem stopped. Oh no, it didn't. This problem wanted me to get the whole equation. And what would it be if they used 420 maintenance hours? So now I'm going to get my fixed cost. I like to be high, so I pick up 4470, which is what? Which is my high total cost. I subtract off my variable cost at the high level of production, which was 520 in this example, right? That difference gives me my fixed cost, and now I can go ahead and set up the equation that you see down here, and this would work for any level of activity. I'm going to rewrite it. I'm just going to write it again. It's a little bigger, which is going to be what? 570 is the fixed cost, plus what? Plus 750 times x, whatever it is, right? And in this problem, they wanted us to give them the answer if our maintenance hours end up being what? 420, what would our total cost be? You just plug in the 420 hours right here, and the answer is 3720, isn't it? That's how to answer that question? $570 plus 750x, and they told me that the total maintenance hours, they said pretend it's 420. If it's 420, I just plug that in, right? Question? Question? Okay, now I went a little further with this, and I said, okay, fine, but as an accountant, I really don't care about all that. What I want to know is what's the predetermined overhead rate? Because I have to apply that to a job, don't I? And so I would take then the 3720 divided by what? The 420 estimated hours. That means my predetermined overhead rate is 880, isn't it? Is it 880? 880 per hour? Right? $8.80 per hour. So if I work 7 hours, what's my, on a job, what's the overhead I'm going to apply to that job? Yeah. Huh? 62, you say? Is that what you said? So you took what? You took 8.80 times, what'd I say, 7 hours? Is that what you did? 8.8 times 7 hours, and you got 62? 61.6? Like that? Right? Question? Okay, good. Now, a couple points, and if you're trying to follow the slides around, I flipped them around a little bit on you, so you're going to probably have to flip back for this, because where I had it before, it wasn't as good as here. Am I talking too loud? Because I can always turn down the volume here. Okay, never mind. Okay, now, when you sit here and you look at your variable cost and your fixed cost, your fixed cost will basically stay the same no matter how many units you produce, right? Your variable costs go up or down with the number of units you produce, okay? So if you look at your variable cost, and you may want to flip around, I moved these on you, flip back to where they're at if you didn't find them. If you look at your variable cost then, your variable costs in total change with the level of production, don't they? Right? Okay? Your fixed costs stay the same regardless of the level of production, don't they? Okay? But if you look on it on a per unit basis, over here on the right, if you look at it a per unit basis, your variable costs stay the same per unit no matter how many units you produce. If it's $6, it's $6 regardless of the number of units, right? Meanwhile, your fixed cost per unit will vary with the level of production. Okay? So you can sit there and you can, what did I say, to sit next to somebody on the bus? And when they sit down next to you, say, hey, did you know that in total, variable costs will increase and decrease with the level of production, but fixed costs will stay the same regardless of the level of production? Did you know that? And then that person moves, and the next person comes and sits next to you. You said, did you know that per unit basis, variable costs stay the same, but fixed costs will change with per unit? Now, I think everyone sees the variable cost. Everybody gets this. Everybody sees how the variable cost per unit will stay $6 per unit regardless, but for some reason, people have trouble with the fixed cost. So let's just go ahead and think about this for a second. So beautiful. It's just so quiet. Okay, so what happens? Let's say my fixed costs are $100,000. That's my fixed cost. And I produce 1 unit. What's my fixed cost per unit? Not a trick question. 100,000. Good. Let's say my fixed costs are 100,000. And I produce 2 units. What's my fixed cost per unit now? Fixed cost per unit is 50,000, isn't it? Good. Let's say I produce, my fixed costs are 100,000, but now I produce 3 units. What's my fixed cost per unit? $33,333.33. The third one is 34 cents, whatever. Right? So is it true that my fixed cost per unit change with the level of production, even though the total fixed cost stays the same? That's all we're saying. Variable cost total up and down with the unit of production. Variable cost per unit is constant, isn't it? So if you really want to be mean to like children, what you could say to them is what? Hey, my variable cost per unit are fixed, while my what? My fixed cost per unit are variable, and my what? My total variable cost are what? Variable. My total fixed costs are fixed. I guess you couldn't mess with them that much. But with the per unit, you could really blow their minds, right? And they'll say, what? And you'll tell them again, and pretty soon they'll go, Mommy, someone's being mean again. It's not as bad as what they used to do to me. My brother and sister used to look out the window and keep saying there was a cat out there. Meanwhile, there wasn't. So I'd keep like, where? Right there. You don't see it? No, where? Oh, where's the cat? Little did they know I'd turn out to be smarter than them. So I mess with them all the time now. Okay, just kidding. Okay. Kind of. Question? Okay, guys, so what we'll do next time is if there are any straggling slides here, we'll grab those and we'll go through the quiz for Chapter 2 and then start to dig into Chapter 3. Okay? Question? If you're here and I'm going to start getting an attendance sheet together and I will track that, but as long as you're here, I give you points for the quiz and the homework. That's correct. Okay? So we'll look at that quiz for Chapter 2 next time. I think so. I don't think you need those other things. No. Some people like to sit there and kind of pore over it when reading. That's the main reason I even select a textbook. Well, there may be some things in there that I don't talk about, but in terms of your tests, no. I mean, there might be some in there that I've decided not to cover in the class. Yeah. Sure.